You do your analysis, you place your trade, and you wait. The market starts moving in exactly the direction you predicted. But before the real run begins, the price dips just enough to hit your stop loss and kick you out. Then, almost immediately, it rockets upward to where your profit target used to be. It is the most infuriating experience in retail trading. It happens because we spend so much energy obsessing over whether a market will go up or down, we become totally blind to the other half of the equation. Knowing the overall direction a currency pair will travel is useless if you don't know how violently it will oscillate along the way. Financial markets are naturally chaotic environments. Every second, millions of orders collide, creating a baseline level of erratic price movement. Traders call this the noise. Amateurs try to deal with this noise by guessing where to put their risk limits. They pick a random number of points that feel safe to them. Professionals, however, don't guess. They mathematically measure the chaos. To stop getting shaken out of winning positions, you have to transition from guessing to utilizing a specific objective metric to measure market volatility. In 1978, a mechanical engineer turned technical analyst named J. Wellis Wilder Jr. created a tool to solve this exact problem, the average true range, or ATR. Unlike a standard moving average, the ATR completely strips away price direction. It does not care if the market is trending up or crashing down. Instead, it measures the sheer size of individual price candles, calculating the distance between highs and lows, averaging them over a 14-period window. When candles get larger, the ATR line creeps higher. When the market settles into a tight range, the line lines drum. The abstract, invisible threat of market risk is converted into a definitive mathematical score right on your screen. The Forex market is an ecosystem of drastically different assets. Every currency pair operates with its own unique behavioral baseline, or rhythm. A highly volatile pair like the British pound against the Japanese yen might swing 150 pips in a single day. Meanwhile, a sleepier pair like the euro against the Swiss franc might only move 40 pips. Applying a standard 20-pip stop loss to both drastically different pairs is mathematical suicide. The pound will chew right through that 20-pip limit as part of its normal daily breathing. The ATR provides the precise, real-time quantification required to adjust your strategy to the specific rhythm of the asset you are trading. Professional traders use this precise data to build their structural defenses. They set their stop losses using exact multiples of the ATR. Rather than guessing at a safe distance, you check the current ATR reading. Then you multiply that value by 1.5 or 2 and place your stop loss exactly there. This buffer ensures your trade has the exact room it needs to survive normal market fluctuations, while you wait for the larger trend to unfold. But the indicator also has an offensive capability. You can use it to anticipate momentum shifts. When the ATR hits multi-week lows, the market compresses. Like a heavy steel spring winding tighter under pressure, periods of historically low volatility mathematically signal that an explosive breakout is imminent. You get a defensive shield against stop hunts and an early warning system for incoming trends. A warning: the most dangerous trap is assuming a rising ATR line means the price is climbing. A surging ATR strictly indicates expanding price ranges. The market could be soaring, or it could be crashing to the floor. You also have to match the tool to your environment. A volatility reading from a 15-minute chart is completely useless if you are trading off a daily time frame. And remember, because this formula averages past data, it is inherently lagging. It tells you what the volatility has been over the last 14 periods. It is an excellent guide for setting your parameters, but it is not a crystal ball for the future. Implementing the average true range forces you to transition from an emotional gambler who guesses at risk to a precision trader who relies on hard data. Once you start tracking it, you realize that the random, frustrating spikes that used to kick you out of winning trades were actually measurable, predictable volatility all along. How do you currently calculate the breathing room for your positions? Let us know your method for setting stop losses in the comments below. Grasping the true scale of market movement is the structural foundation you need to survive in the Forex markets over the long haul.